Hello, everyone, and thank you for joining us for this session on the outlook of oil market supply and demand for 2021, the perspective from Europe. Before I hand over to our distinguished speakers, let me just set the scene. Since December 2020, I have the feeling whenever I look at oil prices, market sentiment, forecasts for this year, I have the feeling there's some kind of happiness in the air. Where confidence seems to be improving. Forecasts are being revised upwards when it comes to oil prices. Very recently, Goldman Sachs forecasted a $65 a barrel for Brent by the summer compared to their earlier forecast for the same figure by the end of the year. The EIA, the US EIA, also upgraded its forecast for prices. And if you look at the activity level, the sentiment about the business activity in the US patches, you find that's also improving and increasing. So overall, everybody, all producers, I would say, investors in the oil and gas industry seems to be comfortable with where the markets are heading. But is it just a temporary reaction because we're coming out of a deep hole that we saw last year in April 2020, or is it going to be the trend for the rest of the year? And what is interesting is that if there seems to be some kind of disconnect between what we are seeing with oil markets, with oil prices, and what is happening on the ground with the spread of the virus, of the coronavirus, especially here, for example, in Europe, but also in the US and in other places in the world. And to quote, some chief scientists, they are warning that the worst is yet to come when it comes to the pandemic. And yet we're having this kind of disconnection between oil prices improvement and what is happening on the ground with the virus and maybe with the economies. Of course, OPEC Plus takes a lot of the credit, but we're going to discuss at this session that lasts for 45 minutes, what are the main drivers behind the improvement in prices, how sustainable the current levels are, what is the outlook for oil demand for this year, what about the supply within OPEC, outside OPEC, and of course we're going to touch on US shale, no escape. But before we go through the details, let me just remind you that we have only 45 minutes and I'm going to take questions from the floor, from the participants as we go along the discussion rather than leaving them all till the end. So if you have any burning question, send it through and I'll try to integrate it within the discussion to the speakers. And also we'll have some surveys, 2 survey questions that we're going to launch throughout the discussion to get your feedback on the outlook for the rest of the year. With this said, with this background shared with you, let me introduce our speakers. We have first Mr. Dedi Imsirovic, who is a senior research associate at the Oxford Institute for Energy Studies. Dr. Valentina Dedi, who is a lead economist at KBR. Rustin Edwards, head of fuel oil procurement, Euronav NV. These 3 speakers are based in Europe, and we have one more speaker who is based in the US, but who's going to share with us his perspective on global markets, Mr. Mark Finley, fellow in energy and global oil at Rice University's Baker Institute. Now I'm going to ask each of the speakers to set the scene with 2 minutes opening remarks. I'm going to start, first of all, with Dr. Valentina, my partner in crime at Access Women and Energy. Please, the floor is yours, and then we can move on to the other speakers to set the scene.
Thank you very much, Carole, and hello everyone. Good afternoon, good morning, and good evening, depending on the region you are watching us at the moment. So yeah, 2020 has been an exceptional year, definitely a year we will remember for years to come. It started with this global health crisis, but unfortunately it metastasized into a deepening crisis for the global economy. It also changed our lives. We saw things happening for the first time, and that had also a big impact on the energy markets and the oil industry in particular. We saw a massive destruction of global oil consumption over the past 12 months, and that had an impact on oil prices as well. We saw prices even turning negative, even briefly in the US. So, but as you said, Carole, over the last few months, things have started getting a bit better, and especially over November and December, we have seen lots of optimism, which could mainly be attributed to the fact that have been trillions in stimulus packages given approved by governments across the world, and of course the news about the availability and the efficacy of vaccines. So not everything is doom and gloom, but as we will discuss over the next 40 minutes, there are things that we need to take into the equation, unknown factors that will affect oil and oil demand and supply over the next 12 months.
Thank you, Valentina. Mark, I'll move to you before I come back to Europe.
Thank you, Carole, and thanks to the organizers and sponsors of this event as well. I want to just briefly raise 3 topics to watch for the market in 2021, and then 3 things to watch in 2021 that will affect the market longer term. For the market in 2021, I think we have to keep an eye on demand and, as you mentioned, the progression of the virus, as well as the strength of any macroeconomic recovery. On the supply side, obviously OPEC Plus, which you've already raised, both the targets that the group sets and their compliance. And I think it's important to note the the recent agreement with Russia and Kazakhstan allowing to increase, while Saudi Arabia unilaterally cuts by 1 million barrels a day. And then finally, U.S. producers. How resilient will the U.S. shale patch prove to be? And at what price will producers get back in the game? I mean, for right now, the balance had turned into a deficit, as Valentina mentioned, although there was a risk that in the first quarter with, demand taking a hit, it could have gone back into a surplus. We'll have to see if the unilateral Saudi cuts obey that. But overall inventories globally have been drawing, but still remain very high. And one potential factor out there to keep an eye on, with the success of the OPEC Plus cuts, that means that there's a lot of spare production capacity and a lot of flexibility for the group to deal with, a tighter market whenever they choose to do so. For things to watch in 2021 that might have longer term bearings, I'm watching policy, economics, and behaviors. Policy, what will green stimulus do, and what might a new U.S. administration do in a couple of weeks' time on the policy front that will impact the oil markets longer term. On the macroeconomic side, are we looking at a potential roaring 20s, like not just a return to normal behavior, but kind of a snapback of almost revenge travel as people do everything that they haven't been allowed to do for the last year? And then finally, behaviors. Are we going to have this meeting in person or online next year? And how will those behaviors durably change or not?
Thank you, Mark. Adi.
Thank you, Carole. Thank you, GI, for organizing this. Thank you, everyone. Well, this year is going to be characterized by just one single word, I think. That will be uncertainty. From the start, it's been a demand shock, and demand will resolve this whole situation. The path of this demand resolution is going to come out basically from the path of the sort of virus and dealing with the virus. Just as we get really, really optimistic with the vaccines, November was a particularly optimistic month with vaccines coming out, the market rallying. We suddenly have this new 2 strains of virus. There'll probably be more. They're more virulent. They're easier to spread. So it really is very much an uncertain period. We look at China as we speak. Last couple of days, there's been further spread of virus in China as well. Japan is not looking that great. So really, uncertainty is a big one. We've never been here before, and it's going to be a learning experience, as Mark just said. It's going to be a very interesting learning experience about everyone. On one side, with the supply, on the supply side, OPEC and OPEC Plus have never been here before. They've started the year very well. Russia got a fairly sweet deal out of everything. Saudis are clearly showing their leadership. We want to see what's going to happen with shale. I think almost certainly we will not see less shale. We're going to see more shale, but how much more, it's also uncertain. So it's really interesting for all of us, even for us, all of those who have been in the industry for many, many years, we are pretty much in uncharted territory. So one word: uncertainty. Thank you.
Thank you. That's very encouraging, Adi. Let's move to Rustin.
Good afternoon, good morning, and good evening to all the participants and all the attendees. Thank you, GI, for setting all this up. There's not much more that I could add to what's already been said by my fellow panelists here. One of the things, though, that will be an interesting facet going into 2021 is how does the financing industry cope with the different changes and the different controls coming in place, especially around the shift from a petroleum-based environment to a green energy-based environment. Do we start seeing a credit squeeze starting impacting some of the smaller trade houses, smaller commodity movers, because they're not going to be able to get the financing that the larger trade houses can support? And I think that also has a knock-on effect on the ability of shale in 2021 to come back in the United States. A lot of people have been burned over the last year with the control of those companies and how they work when it comes to their cash and spend. And now that we're getting into a point where banks may not be willing to finance those operations going forward, is that going to keep a cap on the production out of the US and help contribute to a tighter market going into 2021? I think those are things that are going to have to be grappled with, especially the greening of the petroleum space. If we do shift more and more to a green environment, especially with the current government in the United States, will have a more environmentally friendly bent to it. It could prove challenging for the older side of the industry to move forward. So looking at that in 2021, from a shipping standpoint, we do see the increase in demand and for dry goods and commodities into Asia. And can Asia continue supporting the world as we go forward? So things to think about, a lot of the uncertainty to think about, but definitely things that we can look forward to help move us ahead.
Thank you very much, Rustin. I hope really Mark is right about roaring back with revenge. I like this image because I'm already planning for a big crazy party once this crisis, this pandemic is over. So I hope this will spread, for everybody else. But Valentina, let me go back to you a little bit. If we stay a little bit with the demand. So we know that last year was something unusual. As Adi said, nobody has been here before. But how much of the demand destruction that you refer to is cyclical? So it's just temporary because of what happened with the pandemic. Nobody was able to travel. Nobody was going to go around. The economy entered into a coma for a while. And how much of it is really structural? And what does that mean for peak oil demand? So some people even say that demand has peaked already. So what is your view on that? How much of that demand is going to come back? How much of it may be lost forever? And actually we are in the peak demand phase.
Thank you, Carole. Yeah, that is a good question, and it's something that has dominated headlines over the past few months. There have been projections, including BP's recent energy outlook, where one of the company's scenarios was projecting actually that we might have reached a peak in oil demand, and there have been more projections along those lines. So this is a good question in the sense that it's really difficult to tell at the moment whether the pandemic has accelerated this pace to change. As Andy and the other fellow panelists correctly mentioned, there is lots of uncertainty yet. We haven't, the pandemic is far from over. We are still yet to see how COVID-19 will evolve over the next few months, how successful the vaccination programs will be, and what the pace of the deployment of these vaccines will be. And looking at this, of course, someone might think that okay, the longer the disruption, the more these changes might eat into oil consumption. And especially if you think in these new patterns that we are trying all to get used to, like working from home and not traveling. And if we think back to 2007, 2008 global financial crisis, there have been studies showing that actually during those years, it took about a couple of years for leisure travel to get back to pre-crisis levels, and for business travel even more, about 5 years. And we all know that this crisis is much worse, unfortunately, than this 2007-2008 crisis, which means that there are factors, there are parameters that might actually have an adverse impact on oil demand. However, what I would like to add is that not all these all these changes in consumer behavior disadvantage oil, because at the moment we see that there is a general aversion to public transport. We also see a continuing we see a continuing popularity on SUVs. I don't know what is the case in other European countries, but I can see that in London streets are really full of SUVs. So there are factors that might not that will actually add on will have an opposite effect on oil demand.
Okay, thank you. I just want to go quickly to Mark to get his view on oil demand, and because Mark, you mentioned the behavioral changes and whether we're going to continue with this online business or we're going to go back to a business as usual before COVID. So how long do you think it will take for oil demand to go back to the pre-COVID level? I know things are looking better this year, but I'm not quite sure whether we're going to hit the pre-COVID level marks anytime soon.
I think we can be confident we're not going to hit the peaks anytime soon, the previous peaks. I mean, none of the major forecasting services that I'm aware of is forecasting that oil demand, even on a quarterly basis, will get back anywhere near pre-COVID levels this year. And so, in the best case scenario would be to see global demand, getting back toward pre-pandemic levels perhaps on a quarterly basis at some point in 2022, and on an annual average basis, probably beyond that. And that's even without taking into account, the kind of peak oil demand stuff. It's just, as a function of the durability of the economic and behavioral shock that we're looking at. And I think, Adi was completely right that in the short term for 2021, the virus is in the driver's seat. And how quickly can we get on top of it? Both in terms of, the biology as well as the economic policy dimensions of it.
Great. At this stage, I would like Lisa to launch the survey just to see what the viewers think about when demand will go back to pre-COVID levels. Is it by the end of this year, next year, 2 years' time, or never? It's going to come back. I mean, never say never, but let's see what the participants can tell. Can we also vote? I don't know if we as speakers, I think we can.
Yeah, I think we can.
Yeah, so we can. But before we get the results, I would like to move to Rustin, and I would like just to zoom in very quickly on breaking down the demand by products, oil products. I mean, we don't see the same, actually, we don't see a coherent response of the demand for different products when it comes to what's going on with the economy. Okay, jet fuels is suffering the most. But if you just tell us a little bit what's going on at this level of oil demand.
Well, I mean, jet fuel, that's going to be the dog of the distillate space probably for another year, just because I think it will take a long time for people to get comfortable traveling again. I do think we'll see the resurgence of tourist travel once people get vaccinated and countries start putting the rules down about how you can come in. Do you need a travel vaccine passport with a COVID shot to prove that you can come into a country or not? So I think there will be some pent-up travel that will pick up from the consumer side. Business travel may not pick up as quickly. And so jet is going to be the laggard. I mean, when you look at the heavier side of the barrel, the residuums, demand has actually been fairly good because shipping has been active. Dry bulk, container ships, wet bulk, all moving cargoes around the world. Demand is good in Asia, pulling cargoes into there. So, and we do see it in the price actions right now, with VLSFO, which is the 0.5 sulfur fuel oil, pricing very strong currently. Distillate demand is strong as well, mainly due to the colder winter this year that we've had in a long time. And so that's all keeping support on that side of the barrel. On the heavier residuum side of the barrel, demand is fairly good. Stronger distillate means that most refiners in the US that can coke will coke. And so they'll be buying high sulfur fuel to remove it from the market, turn it into the lighter sulfur materials. And again, you have the ships with the scrubbers. Currently, the last count, roughly 3,800 vessels with scrubbers, with another 1,000 coming online over 2021. So from the residuum side of the coin, things should look fairly good. Gasoline looks more positioned in a seasonal position at the moment. Stocks have drawn down rather successfully. And when you look at the inventory levels reported in Europe and the inventory levels reported in the US, they don't seem to be too far out of whack from what I would say a normal trading year. Maybe a little bit to the high side, but still they're well within the 5-year band of inventory levels. But MoGas might be the big question mark, especially with the insurgence of COVID. I mean, most of the countries here in Europe have done some sort of lockdown, limiting travel, limiting movement. There's some still in the United States as well, so that's all going to impact mainly gasoline demand. Distillate remains strong because people sitting at home, cold weather, they want to run their heaters, and a lot of people still use heating oil as their main source of heat. Then you have all the intrepid demand from industrial use as well as trucking and trains to move goods around it, because we're all ordering on Amazon. So
yeah, I mean, I'm definitely keeping Amazon quite busy these days in the remote Black Forest. But Rustin, what you are saying confirms something which has been quite known for some time among analysts, that the demand side tends to be by far much less understood than the supply side. So I'm going to ask my last question here on the demand before we get the survey results and move on to the supply to Adi, and it's coming from the audience about 2021, is it going to be more a supply side story or a demand side story when it comes to oil markets?
Thanks, Carole. I think I'd probably answer that question in my introduction in a way. It's always been a demand side story, and it will remain demand side story this year as well. It's driven by the virus, as simple as that. Sadly, I think OPEC Plus, they've done a great job, sort of from the supplier side viewpoint, not from a consumer side viewpoint, to sort of stabilize the market in an orderly fashion. But they really are a sideshow to this whole situation. And we can see now with Saudis making additional 1 million barrels voluntary cuts, and I'm sure we'll come back to those points later on in this discussion, that it's still the market. The market did take that positively, but with the recent infections in China, with situation in Japan, again, it just gets hammered every time. So it's remaining a demand side story, and will be for quite some time.
Thank you, Adi. Lisa, is it possible to show the survey results, please? Okay, we have a kind of half of the participants think it's 2023, and only 10% believe that we're not there yet. So there is still some room for hope. Mark, let me move to you and then bring in the supply story. I know in your previous life, and even today's life, actually, you cover extensively OPEC, and of course today OPEC Plus. So what is your outlook for this kind of deal or arrangement that we have at the moment beyond Q1? So we know what is going to happen. At least we know the headline developments between February and March. But what is your outlook for the rest of the year in terms of what the group might do? What about their discipline and compliance, and overall the role that they will play in the market this year?
Mm-hmm. I think that what we've seen from the broader OPEC Plus group in the last year has been unprecedented. And I know we use that word a lot in the context of the pandemic and its oil market ramifications. But I mean, we've seen the largest coordinated production cuts the world has ever seen. We've seen spectacular compliance. we've also seen a very proactive approach to managing, with a much more involvement from, the leadership of the key countries and in their outreach. And in fact, unprecedented agreements, for example, to pay back previous cheating, among countries. So all of this has been, dramatic and it's kind of engagement that those of us who've been watching the market for a long time are just not used to seeing. The question is, can that sense of urgency, persist, as kind of things get back to more normal, and at least in terms of pricing? We're already seeing the cracks starting to show. My read is that Russia, was keen to increase production in January and to proceed with the original plans. And Russian officials and companies have been very clear about their desire to increase lost production, and from a geopolitical perspective, keeping a very wary eye on the market share battle with U.S. shale producers. In contrast, it seems like a number of the Gulf heavyweights have been more focused on extending production cuts and extending the discipline, and it looks to me like aiming for a higher price. How will those tensions, could those tensions, plus the ever-present temptation to cheat when you have spare production capacity, how will those factors start to color individual decision-making among these, more than 20 member participating states? I think that's a great question for 2022, 21 and beyond.
I mean, definitely it's a big question, really, in terms of how successful they will be in putting further and sustainable pressure on prices. And Valentina, here I'd like to hear your views on to what extent you think OPEC Plus will be successful in pushing prices higher than what we are currently seeing for the rest of the year, and whether that is conditional upon other factors, and if yes, what are the other key factors that will affect the success of their strategy?
Yeah, so as Adi and Mark mentioned, so what OPEC has done so far is a really good job. So over the last months, they have managed to manage this volatility in the oil markets and establish some stability. And we should acknowledge that that was not something that it was easy for them. It was a big task. And actually, if we think that it took the largest alliance in the history of the oil industry, going from a group of 12 members to a network of 23 countries, actually, in order to contribute in the production cuts and rescue the market. So looking over the next few months is still a big job, not an easy task, as I said. And this is because there are members within the group like Russia and other members trying to push for an increase in their production. And also we need to take into the equation what will happen in production outside OPEC Plus, like production from Brazil, Canada, but also from countries that are currently exempted, like Libya, which actually has seen a big increase from about, I think, 100,000 barrels per day in August to about 1 million barrels per day by December, and that is having an impact on the already oversupplied market. Another variable we should look at is Iran, because now with the change to the US presidency, there might be a potential of the Iran nuclear, a potential revival of the Iran nuclear deal, although it is highly unlikely that a full agreement will be reached, because there are a number of factors, the political situation in both countries, and also Iran needs some time to get back to full compliance with respect to the deal. And I think Mark, in the introductory remarks, mentioned the US shale is a key variable as well. We still need to see how US shale will respond to this to the recovery of the oil markets, and especially if prices are maintained above $50 per barrel, which is a level where companies can cover their costs.
Thank you, Adi. Before I dig deeper into the shale outlook for this year and for the future beyond this year, Let me talk about some of the producers that Valentina mentioned and which don't get perhaps the same attention as the usual suspects such as OPEC Plus and US shale industry. But for example, Valentina talked about Brazil, Canada, I would add maybe the North Sea if there is any increase, recovery in production loss, but also Libya. I mean, it is an OPEC member, but has been exempt. But to what extent do you think these countries can impose a serious threat on the success of OPEC's influence on prices this year? Are there really serious threats? Or for example, Libya, that said they reach the top they could achieve in a short period of time and they would stay there or maybe not for a while, depending on the political situation. What is your view on that?
I'll be quick. I apologize. There might be some background noise here. I've got some neighbors drilling apparently, but
we can't hear it, so it doesn't.
So far, so
yeah,
good.
it's not coming through. Yeah.
So far, so good. I think again the word uncertainty, and that's the other reason why I pointed out uncertainty is a very, very important thing. I think Valentina mentioned Iran. We have Venezuela situation. Libya is a very difficult one. I think Libya are probably reaching close to their peak because of all the infrastructure. And of course, now from here, we can only probably have more bullish situation or some downside because until all the political issues have been sorted out about payments and who gets the money. Iran, I think Valentina mentioned extremely well. We've got Mexico as well, Canada, and particularly Norway in the North Sea. I mean, the feeling generally is that we'll see next year non-OPEC producers adding about 1 million barrels of liquids. Careful here, not necessarily all crude. A lot of it is condensates, according to Energy Intelligence at least. There's some new project coming from Norway. Canada is particularly going to be strong, I think. They're coming out with 280, probably up to 300,000 barrels a day. Because the crude, obviously, IMO, if you all remember IMO now, it's a flip side of the whole thing. If you've got heavy, high sulfur crude, you're a winner, basically. So yes, they're going to add, but in no way is non-OPEC going to actually substitute OPEC barrels in any meaningful shape or form in case of a demand rebound. A lot of positive commentaries out there that I saw we're seeing in 2021 increase in demand up to 6 million barrels a day. That's a huge increase. While we do have OPEC surplus, I think is about 7.8 million barrels. It still may not be able to bring it immediately. We do have high stocks as well, so I wouldn't get terribly bullish. But if we did see that sort of resolution of the problems with the current pandemic, we could see extremely tight market towards the end of the year. So not all is doom and gloom. We could actually see quite a spike. We'll come back to shale, so I will not say too much about that, but I totally agree with Valentina. I think latest Dallas Fed survey had for new wells, 46 to 52 range dollars a barrel for WTI. We're well inside there. So shale will be picking up as well.
Rustin, you mentioned earlier, you seem to be in agreement with Adi that most likely we're going to expect a tighter market probably by mid to end of this year. And you also highlighted the issue of financing. From what you heard from the other panelists, what should we expect in the shale patches when it comes to a recovery of investment in the light of the constraints when it comes to financing? But aren't higher oil prices sufficient enough to boost investment and money injected into the sector?
Well, it's a function of sustained higher oil prices. I mean, we've been in an upward trend for crude for the last 8 weeks. And if the trend holds and we start breaching $60 Brent, which means $57 TI, you'll have a much more comfortable position for people to re-enter the space and reinvigorate the system and start increasing the exports. and the production. I mean, one of the issues that had been troubling shale growth has been the export bottlenecks, and a lot of those have been resolved. I mean, you've got more capacity that's now come online to take away the oil, and so you can now get higher production rates out and get the barrels to market more efficiently than you were probably at the end of 2019, beginning of 2020. But you still have people who are probably smarting from the negative WTI cost pricing back in April. And the fact that that risk sits has made banks a little less enthusiastic about going into the space. Hearing from the CEO of Pioneer Resources that he needs to see more consolidation amongst the producers so that they can actually control costs better and keep things better in line to have a more better production margin. And I think that's something that still needs to happen, and we'll probably see some of that happen in the company side. If companies start merging and realigning themselves, they'll get much better cost structures and be able to come back with a vengeance. But haven't seen the merging yet, but it is starting. Carole, you're on mute.
That's why I don't like to put myself on mute because I keep on forgetting myself muted. But Mark, before I come back to you on the question, elaborate a little bit more on shale, because I think you're quite close to that scene, perhaps, than at least myself. Let's ask Lisa to launch the second survey question, which is on OPEC Plus and the longevity of this group. I know what they did is something extraordinary, but since it came together in December 2016, there is no shortage of people talking about it falling apart because of diverging interests, and yet they proved everybody wrong so far. But how much longer can they last? I mean, for after the end of 2021, next year, 2023, or is it going to be here to stay? So let's give it a few minutes. And then meanwhile, before we get the results, I will turn to Mark and get your views on US shale industry, especially under the new administration, the Biden administration, which is not as oil and gas industry friendly as the Trump administration. So how can we reconcile the fact that you have an important industry for the US economy, for job creation? Also, it gives the US a lot of weight when it comes to foreign policy, even imposing sanctions on other countries such as Russia, and the Biden administration climate change agenda, which may result in punishing an industry and actually doing OPEC Plus a big favor. So how is it possible to reconcile between the two, you think, under the new administration?
My expectation is that the incoming Biden administration will place additional regulation on the U.S. oil and gas patch, but that it will be incremental. And so a lot of the overheated rhetoric that you may have heard during the campaign about a fracking ban, nationwide, that was not in, even the Biden platform. What he had proposed to do was to ban new drilling, new permits on federal lands. But the majority of U.S. onshore production is on private land, so that's really, it's at the margins. You can also expect to see more regulation or renewed regulation of methane emissions, which again, could add some cost to the system. But I think the bigger factor by far is, the combination of the industry's technical progress and its financial strength. And so I think the bigger issues for the shale patch going forward are, can it continue to drive massive productivity gains, which were the key to the shale patch surprising people during the last price downturn. There the evidence hasn't been great. Productivity had kind of leveled off pre-COVID. Now you're seeing productivity gains, but that's because you're only working the best prospects with the best rigs. The other part is the financing side. Right now everyone says they have financial discipline, but human nature being what it is, when the price goes up, people will get excited, and the question is, will the banks go along, or will the banks, because of their own shifting prerogatives and ESG pressures, make it more difficult for the industry to on a going basis to access capital?
Since you mentioned ESG, let me turn back again to Rustin, ask you very quickly. I know ESG has been growing in terms of popularity, and people think that it would be a major decision that investors will take into consideration when deciding where to put their money. But to what extent do you think today it is playing a role in directing where the money is going versus the expected rate of returns? After all, investors are after the most attractive returns, at least the conventional investors.
Well, I think personally that ESG is driving a lot of investment decisions from banks and from funds in general, because people want to do the right thing. I mean, chasing after a dollar return, which ends up destroying rainforests, may not be the right answer, and it may not help your shareholders in the future to be associated with something along those lines. So I think it is driving decisions, and it is putting tighter controls on projects that get financed, especially if they don't have a good grasp on what the carbon footprint or what the environmental output or harm could be done by that project. So I think there is a fair amount that is going to be driving investment decisions going forward. And I think we're seeing it also, we see it in the oil majors right now as they're pulling out of forward production for crude, but looking at alternative energy sources, biodiesels, and other greener energy methods in order to transform their own companies from a oil-based to a more acceptable base when it comes to advanced energy technologies.
It's interesting because the oil majors, the private oil majors, at least in Europe, they are doing that. But in a world which is still needing oil and gas in general, they might be leaving an interesting gap for the national oil companies and maybe for the smaller players to fill. It's a big question about strategic decisions that is worth really a very detailed discussion.
I mean, if you just look at the amount of money that's been pulled from E&P budgets across all the publicly traded oil major companies, I mean, the last figure I saw was close to $80 billion removed from forward exploration projects. And that's going to dramatically impact oil supply going into 2023, 2024, when those projects that would have been financed this year would have come online. And so there is a whole bunch of forward supply that's been deferred or even removed that may not come in. And that could really drive prices higher.
Yeah, let's look at the survey results, because I'm conscious of time. We have 3 minutes left. I'll be very interested to see. Oh, wow. Again, here we have half of the participants believe that OPEC Plus is here to stay. Let me go now to Valentina just to comment on a related question to the survey result. Valentina, I would love to hear your views on why did the Saudi do what they did this month at the OPEC Plus meeting? Why did they decide to go unilaterally cutting 1 million barrels a day? I doubt it's just a gesture of kindness from the kingdom. They must know something, perhaps, that their other fellow OPEC Plus producers, maybe they know, but they cannot go along with.
Yeah, that is a good question and a tricky one to answer, to be honest, because I think if not all, the majority of us were surprised, but this move from Saudi Arabia to have this unilateral production cuts of 1 million barrels per day. Yeah, as you said, probably, the rest of the group know the reason behind it, and personally, I don't know it, but I just believe that they see that it is to their interest to do something like that.
Mark, I can see your comment here, desperate for $3 signs. So please tell us a little bit more. We have 2 minutes left.
With inelastic global supply and demand, the short-term revenue maximizing position is always to cut production and go for a higher price. Yeah, it may not be sustainable in the medium longer term. It's always better if you can get other people to go along with you, but that's the simple economic math.
And they couldn't convince other OPEC Plus members to do the same, to join in the cuts, for example, the UAE. I mean, they went with this one on their own.
we don't know the private conversations, but by the public conversations, this was not discussed at the meeting. It was something His Royal Highness the minister said that they didn't discuss it at the meeting. He just announced it at the press conference. So that's all that we can work with.
He caught maybe everyone by surprise, but probably not the Russians. We in the last minute, Adi, would you like to add something to what you heard on the supply side?
Yes, I would just like to add to Mark's comments. I agree with him, but on Saudi decisions, I think one of the reasons was also very much to establish the Saudi leadership in OPEC Plus. I think it was very, very important for them to stamp that sort of leadership role. They started everything back in March with just the opposite position, flooding the market. They've actually got the whole coalition together. And now they're basically being charitable and saying, look, I know it's tough. We want to keep this going. I know it's tough for Russia. I think Russia got a very sweet deal out of the last meeting. And with this million voluntary cut, I think they've very much established their leading position in the whole affair. And one last point that we didn't mention today at all, which will be very, very important, especially after 2021, in 22 onwards, is the environment. Didn't talk about that at all. We've got Biden coming in. There will be some sort of carbon tax and other environmental rules and regulations. China has just announced next month they are introducing the biggest ETS, carbon trading emission market in the world. Now, together with Europe, now we've got US, China, Europe, I think is going to be a major force together again to support Paris Agreement with a very major implications for the oil market.
Well, definitely the environment deserves a very, very much longer discussion than we had today. But perhaps people think about the environment, at least from today's perspective, something for the longer term. At the moment, I think most eyes are how do we get out of this doomed crisis? How do we get the virus under control? And there is also the silver lining in this crisis that we're not flying as much as before, so perhaps our impact on the environment is not going to be as bad as we had when business was running as usual. I would have loved to continue discussing the topic of this session. We can go on and on talking about the nitty-gritty details of demand and supply of various players around the world. We touch on some of the major aspects, but this is definitely a big theme, and that's why you are attending this full-day Gulf Intelligence Rich program. Thank you very much for joining us. Rustin, Mark, Adi, and Valentina, thank you for sharing your insights with us. I'm going to say a goodbye to you all now, and apologies I couldn't take all the questions that people were sending through, but hopefully you'll attend other sessions and you'll have a better chance at getting your questions addressed. The next session, I think, will touch also on the outlook for all markets, but from the US experience. Have a lovely rest of the day wherever you are in the world. Thank you very much for joining. Bye-bye.